Caribbean businesses are playing among giants. Access to capital is an essential part of doing business. Businesses need access to debt, equity, credit, and smart capital. When we look at Guyana's stock exchange market, we can see that their market capitalization stands at a little below 2 billion US dollars. When we look at Trinidad and Tobago, which is the largest stock exchange market in the Caribbean based on market capitalization, we can see that they have about $17.65 billion under asset management. Now, when we look at the United States of America, we are seeing that they have approximately 25.9 trillion US dollars in market capitalization. This definitely speaks of a tremendous capital advantage. Among Caribbean nations, it is absolutely necessary for us to raise and amplify the conversation around capital markets and capital access for businesses. The life, the success, the growth, and regional and international integration of businesses depends on access to capital. We at Global Capital Inc. and 10X Branding and Marketing LLC out of New York invite you to join this conversation. Be blessed and see you on the other side. Access to capital is an essential part of doing business. Hundreds of business, thousands of business, and perhaps millions of businesses across the world who have excellent brand fall out of the market largely because they are not able to access capital to scale, diversify, and integrate their brand into the market. One of those platforms that is used to access capital is known as the debt capital market. But to access the debt capital market is not automatic. So today, what we're going to be looking at is how to buy business debt. And in looking at the debt capital market, we will be looking at the pre-qualification criteria. Of course, today I will be giving you 7 of those pre-qualification criteria. This may not be an exhaustive list, but once you can achieve these 7 pre-qualification criteria, anything else the financial institution asks for, you can achieve. Now, those 7 pre-qualification criteria that we're going to be looking at today, one is called the balance sheet. The second is called cash flow. The third is called the credit score. Fourth is collateral. Fifth is what we're going to call the financial records and historical financial data. And the sixth is going to be called cash flow projection. And the 7th is called the business plan. Now, these are some of the pre-qualification. These are 7 of the pre-qualification. Again, this may not be an exhausted list depending on which part of the world you're at. But again, if you can reach these pre-qualification criteria, you can reach any other thing those financial institutions will ask you for. Now, in the event that you're in business or you intend to get into business, I want to ask you to like, subscribe, and share this podcast, because on a regular basis, several times a week, we will be bringing you this kind of content that helps you to make informed and educated decision when it comes to accessing the financial market, whether it be the debt capital, equity capital, credit capital, or smart capital market. We at Global Capital Inc. and 10X Branding and Marketing LLC out of New York, we will bring you those solid information to help you make better business decision. Now, if you're joining me for the first time, do permit me to introduce myself. My name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the self-published best-selling author for several books, including Manager's Toolkit and Billionaire Quotes. I'm also the author for 10X Branding and Marketing Blueprint, the Psychology of Business. You don't want to miss out on this book. Many of you might have been hearing me saying for some time now that that book is going to be out soon. That book has been finished for a little while now, but what we have been doing at Global Capital Inc. and 10X Branding and Marketing is digging deeper into research so as to bring you more information, more substance to help you move your business forward. For example, we have been studying the top 100 companies. We have been studying the mindset behind those multi-billion-dollar industries by US standards. And those informations are what you will get in this new book when it is on the market. So again, this is another reason for you to like, subscribe, share this podcast. So you will be the first to get these information that we're bringing to you on a regular basis. And of course, you will be helping us to meet as much people as possible to get this information out there. So let's get the ball rolling. Today, we are looking at how to buy business debt. Under this heading, we are looking at the pre-qualification criteria when you are approaching the debt capital market or the commercial banks. All right. One of the first pre-qualifications that we're going to be looking at today, it is known as your balance sheet. By your balance sheet, it simply means that you must have a bank balance. But it is not enough to say that you should have a bank balance. The bank balance should be relevant and supportive to the amount that you want to borrow when you're going to the bank. Let's take, for example, that you want to borrow $100 million from the bank. And the bank normally will ask you to get some equity in the game, get some cash skin in the game. So for example, they ask you to get 10% in the game. So you're borrowing a principal of $100 million. They ask you to put 10% equity on the table. It simply means that they're asking you to at least put $10 million on the table as your part of the investment for that sum that you want to borrow. That is called the 10% cash equity. So it's not enough, again, just to just ensure that you have this bank balance, but you need to consider a few things. There may be processing fees, and there will be legal fees associated with the debt that you intend to pay. So it is important that your bank balance reflect that kind of balance sheet to make the kind of impression that you would want to make on your potential investors, the commercial banks, when you want to borrow capital. So it's important that you take this into consideration. Of course, yes, if you go for a lesser principal balance, your equity will significantly come down or increase depending on how much you're going to be requesting. Okay, so that's pre-qualification 1. Pre-qualification 2 is what we call the cash flow. Now, the financial institution wants to be certain that you are having positive cash flow, meaning that every month you have a surplus and not a deficit. So in looking at your positive cash flow, they want to know your income stream, and they want to evaluate your income against your expenditures. And your expenditure will not only take your administrative and operational costs, but it will also now take into consideration the new debt that you're taking and how much that is likely to add to your monthly debt obligation. And the cash flow must be able to show a positive cash flow above your total monthly debt obligation. So again, it's important for you to look at this. If you don't know how to go about doing this, it's important that you get a certified public accountant, get your financial advisors to work with you to ensure that they can walk you through this process. We at Global Capital Inc. and 10X Branding and Marketing LLC out of New York, we have a team of persons who are here to put their best foot forward for you. Now, the third pre-qualification criteria is what is known as the credit score. Now, it may surprise you that there are thousands and perhaps millions of persons across the world that are still not familiar with a term that is called credit score and how the credit score can influence investors' decision to invest with you. And you need to be aware of this, and you need to try to keep tabs on your credit score. Now let's talk a little bit more about the credit score. What is a good credit score? What is a bad credit score? Now, before I get into good and bad credit score, in the developed world, let's take, for example, North America, there are personal credit and business credit. On the personal credit side, we have approximately, well, we have several credit bureaus, all right, or institutions that assess your credit worthiness. But the three that stands out, they are better known as Equifax, Experian, and TransUnion. Those are the three that you are likely to find that are doing evaluation for personal credit. On the business side, you have D and B. And later on, I will go into that to help you to understand how to access it, how to leverage it to ensure that you can significantly increase your chances of getting a whole lot of credit available to you by your credit, leveraging your credit score. Now, let's look at good and bad credit score. What is considered to be a good credit score? Now, anything from, let us say, 690 to 770 is considered to be an excellent credit score. Now, a good credit score may fall within the range of 630 and 689. A fair credit score may fall within the range of 620 and between that range. But anything below 620, anything below 620 is going to be considered a very poor credit rating. And these are things that you really need to take stock of. Now, let me go back to this. Now, an excellent credit score is anything from 720 and above. All right? I repeat, 720 and above is considered to be an excellent credit score. A good credit score is going to fall within the category of 690 and 790. All right, that's called a good credit score. A fair credit score will fall between the range of 630 and 689. And a poor credit score will fall at 620 and below. Now, what this simply means to the investor, if you are showing that you either at 620 or below, it's going to reduce your chance of getting full buy-in from the financial institution, because it is showing that you have debt and you're not able to reach on time those debt obligations. And that, in the eyes of the financial investors, when they see these things, it's not going to be a good motivator. You need to be aware of this. However, if you have 720 and above, everybody wants to do business with you because you have an excellent credit score, and to show that as you create debt, you're able to reach your monthly debt obligation on time consistently, and you are a favorite person to lend to because you are most likely to pay back your debt on time because of your track record. Now, in the event that you may have a 620 and below, all is not lost. There is credit report repair institutions that may be all around your country. But of course, again, this is subjective, because in developing and middle-income economies, they still do not have all of these facilities to help you to quickly do repair to your credit rating. For example, in the developed world, you can simply add a credit line to your credit portfolio, and in adding those credit lines and leveraging it in a smart way, it helps to beef up your credit score. The other thing, you need to ensure that the credit bureaus, they are reporting to or people that you're doing business with, they are reporting to the respective credit bureau so as to ensure that they can fix that. Now, again, you may have these credit repair institutions and agents and specialists who may be able to go to the ground and have that corrected for you within a shortest possible time. So I trust that this information, you find it to be useful. Your credit score matters. Now, the fourth item that I want us to look at today is what we're going to call the collateral. And of course, there is two types of collateral. There is cash collateral, and there is fixed asset collateral. Now, collateral, the cash collateral is still self-explanatory. And what this means is that in a number of cases, when you go to a financial institution, particularly to the debt capital market, and you want to borrow $10 million, they may ask you to front a cash equity of about the same amount to have it be placed in a fixed deposit account, or to have a fixed asset that is much higher than the sum that you're going to be borrowing. That helps the financial institution to have some confidence in you, to feel as though that their investment in you is not going to be exposed to any risk, because if it is exposed to any risk, they can quickly liquidate your asset, your mom, dad, uncle, aunt, or friend asset, and cash out the monies that they would have given to you. Now, let's talk about this a bit, because I want you to ask yourself, why would a financial institution ask you for collateral? The financial institution has a moral, ethical, and professional responsibility to ask you for these things. Why? Because of the fact that the monies that they're investing with you are not necessarily their personal funds. They're taking all of the small depositors and big depositors' funds, and they are making those monies available to you. At the end of the day, they still have a financial obligation to their depositors. All right? So it is smart business and prudent business sense to ensure that you can protect your risk and eliminate risk associated with lending. So there's two more things that I want you to look at. The bank has an obligation to do this. They have a moral, ethical, and professional responsibility to do this. And there's absolutely nothing wrong with this. But today I want you to consider this. There's what I call the banker's perspective as it relates to the collateral, and I've just given you how the bankers see this. But also we have the business owner perspective. In most cases, as a business owner, you see the dollar sign and you see access to capital. But are you thinking just like the bankers in terms of protecting your asset, your mommy, daddy, uncle, auntie, or your friend asset? You also have a moral, ethical, and professional responsibility to ensure that the asset that you're putting on the asset management or asset leveraging it for equity is given the highest degree of protection. And there are ways in which you're going to do that. But stick up in here. I will come right back to this thought, just to hold your thought right here. But just let me explain something else about the cash collateral. Now, here is where you have the cash collateral, $10 million or $100 million, that's fully secured the sum that you're borrowing. It is sitting in a bank account, most likely a fixed deposit account. It is not sitting there as a non-bearing account. It's going to be bearing interest. So let us suppose that that account is going to give you 2% per annum. What it simply means is that over a year's period, if you get 2% over the 1 year period and you borrowed a debt at 10% per annum, that 2% interest that you're getting on that fixed deposit can be deposited right over to the debt account and bring down your debt cost to, instead of you paying 10%, you're going to be paying 8% because you have this savings account, this special account where you have deposited your $2 million as cash collateral that is bearing interest. Now, there is so much more that I want to talk about in relation to this, but I'm not going to go here now because what I want to hint you on is that the interest can go to pay down on the monthly debt obligation, or it can be paid directly to your principal balance. Those are things that in another broadcast I will get into, and I will show you how things like that can help to fast track the debt life cycle, reduce the debt costs, and a range of other things. But we'll look at that at another day. Now let's come right back to the fixed assets collateral. It's important that as you take mom, dad, uncle, and friend equities, assets, and leveraging those assets to buy a debt from the debt capital market, just like the bank will protect their interest, you need to know that you're protecting the interest of those who are investing confidence in you. Now, in most cases, you are not seeing all of this. You're not necessarily thinking through the entire process. And this is why we often say, get a certified public accountant, get your PFA, by professional financial advisor, personal financial advisor that can walk you through this entire process, get you to see the entire process, and you know all the risk associated with what you're doing, and you know how to avoid risk, how to mitigate those risk factors. Because they're assets that you may be leveraging or your family's asset to acquire capital. But there's something that we call performing assets. And if you understand this well, you can leverage those performing assets in a manner that they are performing. And the performance of the assets is provided cash flow, and those cash flow is putting you in a better position of strength to pay back your debt on time, every time, with consistency. Pay up front on that debt, pay towards the principal balance of that debt. But those are things that we will get into later on. However, collateral is key, and today we looked at collateral, but we look at collateral from the standard perspective that is out there. We also look at it from a banker's perspective, and we introduce some new concepts by saying that you also need to look at collateral from the business owner perspective and how you can mitigate all risk associated with taking assets and putting asset as collateral to gain debt. And that's why, again, we are here at Global Capital Inc. We are here at 10X Branding and Marketing LLC. We have a team of professionals that are here to go to work for you, to ensure that we are helping you to make smart business decisions, smart financial decisions, all right, that will bring down your debt costs, get you out of debt earlier, and show you all the smart ways to do business. So let's talk now about financial records and historical financial data. Now, it is smart business. Any investor that is going to be invested with you, they want to see your financials, all right? The financials, perhaps the last 2 or 3 years, some may go as far back as 5 years, some may take, for a second year. It helps the financial institution to assess your business performance. And in looking at your business performance, it also helps them to make an informed and educated decision as to why they should invest with you. I said that again, when the commercial banks, when the debt capital market is invested with you, they're not investing their personal monies with you. They're investing a sum of small depositors and a sum of big depositors, deposit into your business. So they have to protect those depositors' interests. All right. So it's important that you recognize this. And I think this might help to reduce the level of frustration that you have at some time when it comes to going to accessing debt and you're not being able to access it, perhaps because of not being able to reach the pre-qualification criteria. Of course, we know in some cases the pre-qualification is high, but smart investors do everything to protect their interests. All right. So the last thing that we're going to be looking at today is what is known as the second to last thing cash flow projection, and the business plan. Now, many of you would have heard me saying before that doing a cash flow projection, there are three approaches that we are seeing people are using. One is known as the primary market research. You're developing your cash flow projection based on primary market research, or you're developing cash flow projection based on secondary data market research. And that could be using outdated data and perhaps reliable data. There are risks associated with secondary data. But in the worst case, we're also seeing persons who are using speculative data to do their financial projection. And here is where we say that you can be putting your mommy, daddy, uncle, aunt, and friend equity at risk when you do speculative analysis and you build that into your cash flow projection, because you have developed it from speculation, from guess, and there's no guarantee that the business is going to cash flow based on speculation. And this is one of the reasons why we bring you back to the primary market research, because primary market research is going to really help you to understand your business model, understand your consumers, understand their needs, wants, and expectations, dreams, hopes, and aspirations, understand the market size, the market geographical dispersion, how to access those markets. It helps you to identify your competition, to understand the strengths and weaknesses and opportunities and threats. And in understanding these things, you can now build a close to accurate cash flow projection. And this is what is more reliable. All right. This is what will allow you to cash flow, particularly when you take it one step further and you identify your enablers, you identify your accommodators, and you start to build out relationships with those players. For example, some of your enablers are your consumers. Doing the research, you may be able to interface directly with the consumers and build relationships with perhaps hundreds and thousands of the direct buyers. They may have buy-in before you launch that new business idea, that new products or that new service. And that buy-in allows you to be able to cash flow that business from the start. And this is how things that you would need to take into consideration when you're doing your cash flow projections. Stay far away from the guesswork. Take the guesswork out of business. The reason why you're going to fail is because you're doing a whole lot of guesswork. You're doing speculative data analysis, and you don't build successful brands. That you can hurt yourself. You can hurt your mom, your dad, uncle, and friends who are fronting their assets to position you to access credit from the debt capital market. And you don't want to do this. All right? There's a smarter way to do business. Here again is where we come in to give you the best advice, the best support when it comes to accessing the business credit. All right? Business debt. Now, the last thing that we're going to be looking at today is your business plan. You need a business plan because the business plan allows you to have a clear mental picture of what the business is about. It helps you to have a clear picture in terms of who's your target market. It helps you to get a clear picture of what is your business value proposition. All right, your business plan takes into consideration all of the necessary issues that must be considered as you go into that business. It also provides you an anchor point, you see, if you don't have a business plan, and it really surprises me when I hear some people who are in the public domain that will say to people, you don't need a business plan. That is so sad. You need a business plan. Your business plan is your blueprint. All right? Your business plan gives you timeline. All right, start dates and end dates and completion criteria. Your business plan is where you introduce strategic approaches that you can use to achieve the business objective. So financial institutions across the world, all right, depending on which part of the world you're at, they will ask you for your business plan. So my advice to you is that get your business plan. All right, be prepared. So what are you going to the debt capital market? You have it. Whether they need it or don't need it, you have it. All right. Along with this, it's important for you to reflect on all the issues that we talked about and ensure that you're applying these systems to your business life. And of course, today about how to buy business debt. And today's topic in particular, we look at pre-qualification criteria. And those pre-qualification criteria that we look at today, we begin by looking at your balance sheet. We look at your cash flow. We look at credit score. We look at collateral. We look at your financial records and historical financial data. We look at cash flow projection, and we also look at your business plan. Again, my name is Gary Thompson. It has been a pleasure being with you today. And remember to like, subscribe, and share. And so you can be the first to get this information that we're bringing to you on a regular basis. All right. Be blessed and see you in the next broadcast. Caribbean businesses are playing among giants. Access to capital is an essential part of doing business. Businesses need access to debt, equity, credit, and smart capital. When we look at Guyana's stock exchange market, we can see that their market capitalization stands at a little below $2 billion US dollars. When we look at Trinidad and Tobago, which is the largest stock exchange market in the Caribbean basin, market capitalization, we can see that they have about $17.65 billion under asset management. Now, when we look at the United States of America, we are seeing that they have approximately 25.9 trillion US dollars in market capitalization. This definitely speaks of a tremendous capital advantage. Among Caribbean nations, it is absolutely necessary for us to raise and amplify the conversation around capital markets, and capital access for businesses. The life, the success, the growth, and regional and international integration of businesses depends on access to capital. We at Global Capital Inc. and 10X Branding and Marketing LLC out of New York invite you to join this conversation. Be blessed and see you on the other side.